The Supreme Leader of Iran is dead. Confirmed by Iranian state media, announced on state television, described by his own government as martyrdom. Ali Khamenei, 36 years in power, the man who built every proxy network, every missile program, every nuclear negotiation since 1989, eliminated in a single night of U.S.-Israeli strikes. And within hours, the markets that never sleep delivered a verdict that morning television has not yet caught up to. My name is Marcus Caldwell, independent market analyst. I've been tracking the structural pressure building in gold, silver, and energy markets for months. What I'm showing you today is not an interpretation. It's data that's already priced and publicly verifiable. The question isn't whether something significant happened. It's whether you understand the financial architecture of what comes next. Let me give you the market snapshot as of March 1st at 8:46 a.m. Eastern. Gold spot was trading at $5,292 per troy ounce. The overnight range ran from $5,182 to $5,299. The previous close was $5,194. That means gold gained over $100 while Western exchanges were closed. Gold futures technical targets for the upside scenario run as high as $5,680 per ounce if bullish momentum holds into the March 2nd session opening. Before I show you the physical market data that the financial press has completely missed, if this kind of pre-open intelligence matters to you, subscribe right now and hit the notification bell. This channel exists to give you institutional-level analysis with zero products, zero signals, zero conflicts of interest. Your subscription funds completely independent research. Now let's look at what physical markets were actually pricing overnight. Physical gold in China's dark market touched $6,000 per ounce overnight. Not a futures contract, not a paper promise. Physical gold at $6,000. PAXG, the tokenized gold instrument that gives real-time price discovery, when Western futures are dark, hit 5,600 before pulling back to 5,400. That's $122 above Friday's Western close of 5,278. Silver told an even more striking story. Western spot closed Friday at $93. Shanghai spot traded at $105. Shanghai futures at $108. Physical buyers in Shenzhen were paying $120 per ounce, a $27 premium over Western paper prices. In India, silver surged to 3.25 lakh per kilogram amid the conflict, with international spot holding near 94.50. Now here's the mechanism that makes this conflict structurally different from every prior Middle East escalation that precious metals traders have watched spike and compress within 72 hours. It's not just Hormuz closure risk, it's what Iran is actually doing to the physical infrastructure around it. Two vessels were on fire near the strait overnight. A Palau-flagged oil and chemical tanker struck near Kasab at the entrance. A second vessel, the MKD Vaughn, with 4 crew injured and 20 evacuated. Insurance costs for a $100 million oil tanker jumped from roughly $250,000 to $375,000 per voyage, a 50% overnight increase. 150 tankers dropped anchor in open waters. Oil and LNG carriers refusing to move, sitting off the coasts of major Persian Gulf producers. Maersk suspended all Strait of Hormuz transits entirely, but Iran's strategy extends well beyond the strait itself. They hit Jebel Ali in Dubai, the port handling 60% of UAE imports. They struck Mina Salman in Bahrain, home to the U.S. Fifth Fleet. They hit Haifa in Israel. They hit Duqm in Oman, the port built specifically to bypass Hormuz risk. Iran is not trying to sink ships. It is igniting infrastructure that air defense systems cannot protect. Patriot batteries cannot defend cranes from drone swarms. A significant Strait of Hormuz disruption affects approximately 20 to 25 million barrels per day transiting through that single choke point. A total Iranian outage could add roughly $17 to $23 per barrel, potentially pushing equilibrium prices into the $80 to $100 range. U.S. crude is projected to rise by 9% when trading resumes, potentially pushing the benchmark above $73 a barrel. Now I need to give you the geopolitical layer that makes this different from any prior escalation. Khamenei's death immediately triggers an Iranian succession crisis with no clear resolution. Under Iran's constitution, an interim council assumes power, while the assembly of experts, 88 Islamic clerics, selects a new supreme leader. But Israel says its opening strikes killed 7 senior defense and intelligence officials and targeted 30 top military and civilian leaders overall. The chain of command that would manage the succession is partially destroyed at the moment a succession is required. 2 senior Shia religious authorities issued fatwas calling on Muslims worldwide to take revenge, identifying the United States and Israel as the main perpetrators and describing retaliation as a religious duty. IRGC commanders still alive and issuing statements. Ali Khamenei, one of the Supreme Leader's closest confidants, vowing an unforgettable lesson. A government in succession chaos, religious fatwas demanding global retaliation, and an interim leadership with no clear mandate. That is not the profile of a situation that resolves in 72 hours. Now here's the counter-argument, and I always show you both sides with equal force. Trump told CBS News that a diplomatic solution is easily possible, much easier now than a day ago, because they are getting beat up badly. Those words matter. A regime in succession crisis, with commanders reportedly seeking immunity, according to Trump's own statement, may produce a faster negotiated off-ramp than overnight market pricing assumes. Gold's gains beyond the 5,500 level could be capped by a potential U.S. dollar rebound, especially if crude oil forces a Fed response. And historically, precious metals spike and compress in documented phases during conflict. Fear spike during escalation headlines, then normalization, as institutional flows reassert price management. That pattern is real. It has repeated across every prior geopolitical precious metals event. But here is what that pattern entirely misses about this specific moment. The war event did not land on a calm market. It landed on a silver market that was already in its 6th consecutive year of supply deficit. COMEX registered inventory already down 75% before the first missile launched. 52.6 million ounces demanding COMEX delivery on first notice day. Physical Shenzhen buyers already paying $120 per ounce. Shanghai futures already at 108. Gold had already gained 22% in 2026 alone, its 7th straight monthly gain, the longest winning streak in over a decade. Gold entered 2026 at roughly $4,300 per ounce. It's now more than $1,000 higher. The war didn't create this structural thesis, it detonated on top of it. Here are 5 specific things to monitor when Western markets open Monday. Watch the gap size on gold and silver futures at the open. Analysts project a $200 gap on gold alone. Watch whether the Shanghai silver premium widens past $27 or begins to compress. That single number tells you whether the physical to paper gap is expanding or healing. Watch whether oil holds the 8 to 10% overnight gains through the first 2 hours of trading or gives them back. Duration of the oil move separates a war premium from a structural inflation trade. Watch strike duration and whether Iran's interim command signals negotiation or escalation. Trump's diplomatic solution comment is the most important variable in the counterargument. And watch the COMEX Vault report Monday afternoon. 52.6 million ounces demanded delivery, against 86 million ounces in the vault entering the weekend. Those 2 numbers are going to meet this week. Everything I've referenced is verifiable in under 10 minutes. PAXG price on any crypto data platform. Shanghai premium publicly tracked. COMEX Vault reports on the CME Group website. Military operations confirmed across NPR, Washington Post, Al Jazeera, Times of Israel, and Axios with full timestamps. Physical buyers in Asia paying $120 for silver are not selling at a loss because Western banks prefer lower paper prices. The physical market traded all weekend and showed you exactly where informed money values metals when futures cannot interfere. 3 assets now trade on necessity, not sentiment. Gold, the monetary reset hedge. Silver, the industrial shortage play. Oil, energy that cannot be printed. All 3 are spiking simultaneously while the world's most critical energy choke point sits functionally frozen. The succession crisis in Tehran, the fatwa calling for global retaliation, the 150 tankers sitting at anchor, the $27 Shenzhen premium on silver. These are not headlines. They are data points in a sequence that has a direction. Drop your read in the comments. Do you think the diplomatic off-ramp materializes before Western markets fully price the structural shift? Or does the gap slam normalized playbook fail this time? Precisely because the foundation it was built on no longer exists. If this analysis gave you something that the morning news didn't, share it with someone who needs it before Monday's open. Like this video, it tells me the depth of analysis is worth continuing. There are weeks that reshape decades. This may be one of them. Verify before you act. Think before you move.